Welcome Mr. C.K. Venkatraman, Managing Director with Titan. Mr. Venkatraman, this is your first time on ET Now, so very warm welcome. I'm sure you were not prepared for this kind of a drop down in your quarterly numbers. We are welcoming you on the show for the first time, but I'm afraid I'll have to ask you a difficult question, which is that what went wrong for the quarter gone by?
Actually, for the entire quarter, I was the Chief Executive Officer of the Jewelry Division. And therefore, the results that we are talking about are essentially to do with the Jewelry Division. So I was very much prepared for it, even though I am speaking in the role of the MD at the moment. So we knew right through the quarter that the industry demand was under severe pressure. In fact, today's media reports suggest that the imports into the industry fell by as much as 32% during the quarter. And in light of that, our own flattish to small minus single-digit performance is a continuing sign of our growing market share in the business. And while we wish things could have been better, we were quite satisfied with what we did and the results that we finally got.
Revenue growth trajectory, sir. Q2 FY18, 32%, Q2 FY19, 26%, Q2 FY20, less than 1%. So my follow-up question is that what was growing at 20% plus or even 30% plus has now become single digit. I mean, that is the scary fall, isn't it?
Sorry, could you repeat that?
Fair point. I have your growth trajectory numbers. Q2 FY18, 32.8%, Q2 FY19, 26.6%, and for the quarter gone by, which is what we are discussing, the number stands at less than 1%. Revenue growth trajectory.
Oh, you're talking about the same quarter 3 years in a row?
Yeah.
Yeah, I understood that. But what we need to look at is the growth in FY19 and the growth in FY20 together. And it was in the context of that the growth in FY20 was also set at 20% plus, which as a result of worsening consumer sentiment and its impact on high-ticket purchases like jewelry and the price of gold itself, which has really ballooned in the last 4 months, has led to a big industry situation, and obviously our performance cannot be totally distinct from the performance of the industry, and that's why we are where we are. So obviously for us to go back to the growth trajectory that we are used to and what you were pointing out to, we need to do much more of innovation, much more of creative activations to get customers to come to our stores, which is what our teams are at work in, and I'm very confident that we will come back to it in the near future.
Mr. Venkatraman, just looking at your earnings as well, and what struck everyone has been the fact that you've cut the FY20 guidance, and that too quite significantly from the earlier 20% to now 11 to 13%. Why such a sharp drop? Because your commentary seems pretty confident, and you said that you're pretty comfortable with the numbers that you've reported in the quarter.
If I go back to the the earnings call of quarter one of FY20, and that was in the first week of August. So all of us knew that the July month for the jewelry business was a decline month, and I had spoken about an improving situation in August, and we were looking at a comfortable growth in August and September, and at that time our H2 guidance continued to remain plus 20. But what happened in August was more or less as per plan, but September was a little lower than plan. October, which is the Diwali season, which ended a week back, the growth was only 10%. And as we reached out to understand the on-ground situation, how customers are feeling, how some of our large customers, what we call the Purple Club, we directly reached out to them, and our understanding was that people are really holding back their expenditure in many categories, including high-ticket categories. And therefore, we had to be realistic about our near-term outlook, and therefore the guidance, bringing down to 11 to 13% for H2 was in that context. So that's the background to the lowering of the guidance.
Okay, but just just to delve a little deeper into what you've said, given the fact that we're just coming out of festive season and we're discussing the numbers gone by, are you still? I mean, do those all the factors that you've just talked about, do they still stand for H2? I mean, do you really see the situation continuing to sort of be difficult?
See, it's very difficult to predict, beyond a point. We know that July onwards things have been erratic and just not consistent. And the most recent growth rates, I'm talking about now, at least 10 weeks going back, is in the very, very early double digits. I mean, 10, 11%. So it's been a consistent performance for the last 10 plus weeks. And therefore, there is nothing that suggests that things can suddenly change, out of turn. And we are aware, we have multiple levers, engines of growth as we call them. We know the performance of each one of those engines over the last many months, and there is a certain consistency to which some are performing very well and some are not performing so well. So when you put all this together, you get a sense for the next few months, unless we create some new sort of reinvent some of the weapons, create new opportunities for growth, all of which the teams are seized of and working towards. But it would take a few months to, sort of polish all of that and put them into place. So till then, we need to reckon with the reality of today. And also, finally, we look at this business and our company in a slightly longer term than a quarter or H2. We know that the brands are in the best place, the opportunities, particularly in jewelry and eyewear businesses where the market shares are so low and the headroom for growth is so high, that our medium-term and long-term outlook is nothing but good. But we need to sort of tighten our belts in the near term to reach that place.
But could you also explain this 120 crore rupee hedging impact which is coming on the revenue in the quarter gone by? How does the movement on gold prices affect your hedge contract?
No, actually what happens is, let me just illustrate this. Let's say the price of gold, the average price of gold was 3,000 rupees in Q2 of FY19. This is the price that we realized, from customers. And let's say the average price that we realized from customers was 3,400 rupees in Q2 of FY20, which means that on the price account, we grew 3,400 by 3,000, which is about, let's say 12% or 13% roughly. But this gold, which we sold in Q2 of FY20, was bought either in Q1 of FY20 or Q4 of FY19, and it was given into production. It became stock and it got sold in Q2 of FY20. When we bought the gold, let's say the price was 3,100, and on the day we bought the gold, we hedged it at 3,100, which means when it matures, now the difference we have to pay to the bank. So since it matured in Q2 of FY20, that 3,400 minus 3,100 had to be paid to the bank. Whereas 3,400 divided by 3,000, which was last year, is the growth from a customer point of view. So in a way, the real growth, because it's a commodity with dynamic everyday price change, the real growth has to be sort of reckoned by taking the hedge into the overall accounting of your sales. That's the background to this. This does not affect the profitability of the business, because it's just on the top line side. And it's something that unless we do not hedge, in which case this hedge squaring off will not happen. But if we do not hedge, the business is totally open to a huge risk in terms of the potential fall of the price of gold. So that's the explanation for this. Is nothing to worry about, but we need to report it because it is to be reported.
Will you have any substantial benefits because of the corporate tax cut?
Certainly yes. Certainly yes.
And how would they filter through?
if I remember right, it's of the order of some 30 crores for the quarter.
Okay.
Because the tax rate has fallen, I think, to 25%.
You've added a lot of new business lines, which is your eyewear segment. You've added the perfume segment. Are you likely to go easy on any of your new product line additions you've done? Are you looking at significant diversification which takes you away from the watches and the jewelry business? What is the plan in place for incubating new businesses? Because I remember when I started tracking Titan, it was a watch company and you incubated the jewelry business, and the jewelry business today has become the heart of the business. Is there anything which you are looking at expanding, creating or incubating?
Not at the moment, because we already have an eyewear business which needs to be scaled up and taken to much better levels of profitability. We have entered a sari business 2 years back, and the opportunity there is very, very large. We are very excited about the customer value proposition that we have put forward, and it's going to be our focus to scale it up and take it to the size that it deserves to be and the profit levels that it deserves to be. The perfume market is significantly underpenetrated, underserved in this country, while the deo market is huge. We need to move millions of people into using perfumes on a regular daily basis. And therefore our focus will be to, at least in the next couple of years, will be to scale up the more recent new businesses like Taneira and the skin brand, and get the eyewear business into much higher levels of profitability. Only thereafter we will think about any other new business.
Today's interaction, can I safely conclude by saying that in your view, yes, the business is going through a rough patch, but you are certain that this is a patch. This is not the telltale sign of what could be a 3-year picture. You think at best, at max, this could be a 3 to 6 month phenomenon?
Yeah, let me just sort of articulate this, taking from the point that you're making. The jewelry industry is a huge industry. The Tanishq brand is a very unique brand in this industry, with so many strengths around it and so many factors converging in its favor in the last 2 to 3 years. The relative position of Tanishq in the industry has only got stronger and stronger in the last 3 years, and even in the quarter when the business has not done well, the Tanishq brand has outperformed everybody else. Our revenues were flat in a quarter where the industry consumption on gold was minus 32% in tons. And therefore, I can safely say that the journey of Tanishq continues unabated. This is a rough patch, which is so much macro in its substantiveness because of the overall consumer sentiments, especially behind discretionary items of high ticket nature, aggravated by the price of gold. So we are just not affected by what is happening around us. Very confident about our future, and certainly guarded about the next few months, but I'm sure we'll come out with plans to excite consumers and continue the growth path pretty soon.
Thank you so much for joining us this morning, Mr. Venkatraman. Good to have you with us and to understand a little better the outlook going forward as well. Thanks for that frank commentary.